Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Daryl Thomas, and today we have the pleasure of interviewing legendary investor Rick Rule, who is the CEO and founder of Rule Investment Media. How you doing today, Rick?
Life is good, Daryl. Thank you for having me back.
Yes, a lot of people are making a lot of money. People have been watching you for years. Their pocketbooks are starting to feel a little better. They've went through some pain and agony over the years as well, but it seems like things are on the up.
You remember, Daryl, as you and I have talked about before, you haven't made it till you've taken it. So when these things are gapping up, remember, despite the fact that you're feeling proud of what your account balance looks like, ultimately it's the cash balance that matters.
Yep, yep, for sure. So I want to get into just the market. I mean, we've talked recently, and I've heard you on a couple of other episodes recently about the market seeming a little bit frothy, about 18 months ahead of your schedule, in terms of like when you felt like these are based on your research, when you thought that these stocks should be running. And so I do want to point to a couple of charts I'm going to share here. The first here is going to be the S&P to uh, gold ratio. I want to share that first because I think that this is a good historical chart. And so let's go here first. All right, so here we have the S&P to gold ratio. Obviously, in the prior bull markets, you've had I mean, significantly when it's down, that means that gold is up. And then you add the dot-com bubble here. You know, S&P was running hot, gold was not. Then you had the first decade of the 2000s, where the S&P was not doing so well and gold was. And then you had this bounce here. And so now it seems like we have a rollover a little bit, but just want to get your perspective on this chart, considering that the market is running hot right now. And so I just want to get your perspective.
Well, two things. I don't know how to value the S&P 500. So comparing the S&P 500 to gold doesn't work for me because I don't know how to value the S&P 500. I don't know if it's overvalued or undervalued or anything like that. It's as though you were measuring the gold price in some currency, like from Bhutan or Uzbekistan, that I don't understand. So I have a difficult time with the concept. I personally believe in absolute as opposed to relative markets because, well, for one thing, I don't own the S&P 500, and I don't own an index of gold companies. Uh, so I need to say, with regards to that chart, you probably need to have somebody with a better general market securities background than I answer the question you just posed. What I think about the chart is that I don't think about it because I don't understand anything about the valuation metrics about half the chart, which is to say the S&P 500. I've said before on your show, the S&P 500 is 40% seven stocks, the big tech stocks. Uh, I don't know how to pronounce NVIDIA, if that's the right thing, much less figure out what it's worth. So I gotta hold back from the temptation to answer that question.
Okay. Well, how about this? Let's do this. So the S&P has one gold company in its 500 index. That's Newmont, which sits at about, let me check. I think it's 115 or 119 from last I checked. 119 at one a 0.15% allocation. And then on top of that, I want to look at Newmont versus the top three companies in the S&P 500. So I actually overlaid those here. You have Newmont year to date, 122%.
Yep.
Um, NVIDIA, 31%. You have Microsoft, 22%, almost 23, and then Apple at 4%. And so how do you think, I mean, you would think that more of these companies would be added to the S&P with this type of performance, especially outperforming the top three within the S&P 500.
Well, I think that'll happen because I think it's going to be a market cap. I think it'll be market cap weighted. What may happen and this is not inside information. This is just a supposition on my part. It may be that Newmont and VRIC merge now that VRIC's CEO has decided to depart and pursue other employment opportunities. If that happened, it isn't the same as adding another S&P name, but it would increase the relative importance of Newmont in the S&P 500. To the extent that Agnico Eagle continues to be as successful as it has been in generating free cash and hence market cap, that would be a logical addition. Again, though, you have a valuation issue. People have remarked frequently about the market capitalization of NVIDIA market cap and Apple relative to the market capitalization of the gold sector. And I don't mean to be a naysayer, but if you look at each of NVIDIA, Microsoft, and Apple, they generate substantial free cash. And the gold mining industry as a whole, if you take it all the way down to the penny mining stocks, is cash flow negative. So, of course, a company that's generating a lot of free cash flow would have a higher market cap than others. If, for reasons that you and I have discussed at length, the gold price continues to run, one would expect that the margins associated with the best gold mining companies will go on the same tear that they went on in the decade of the 1970s. And if that happens, then of course you're going to see fairly dramatic market cap advancement. That isn't a reason, though, not to sell some gold stocks, particularly some of the little ones that have enjoyed 400 or 500% gains in fairly short periods of time. I've got a lot of social media hate in the last week from saying that I was selling 30 or 20, 30, 40% of some of my holdings in the small companies. They're saying, listen, it's contradictory. You say the share prices are going up and you're selling some. It's all personal. The fact that I can sell 25 or 30% of my upside in return for eliminating my downside. And by the way, some of the capital that I'm raising, selling these junior positions, I'm putting back into gold itself, or Franco itself, or Agnico itself, or Wheaton itself. I'm not cashing myself out of the beta part of my bet. What I'm doing is de-risking the alpha part of my bet.
Okay. So yeah, that makes a lot of sense. I mean, I told you last week I bought a gold watch. It's pretty. I like it a lot and everything, but it has actual gold in it, and so
But that's cheating, Daryl. That's a consumer good with gold. You're making yourself feel good about spoiling yourself because you're spoiling yourself with gold.
yeah, that is true. I bought my wife some gold too, so I had to, yeah. So just thinking about so whenever these companies are making a lot more money, obviously, we talked about this last week with the mismanagement of funds that typically happen when companies are flush with cash. And so I just want to get your perspective on who are some of your top CEOs in the industry, and then who you think are some of the top up and coming CEOs in the industry that could maximize this bull market for shareholders. And so, Jay and I, we've had multiple conversations, and he's always looking at the top CEOs
Yep.
and such, and he bets on those CEOs. And so I want to hear the CEOs that Rick is keeping an eye on.
Well, it's easy on the big side because we've got to watch them for three decades. So certainly Amar Al-Jundi, who, as you know, I interviewed at my conference in Boca Raton, the CEO of Agnico Eagle. They've done a spectacular job. And I got to say, every question I asked him at Boca Raton, he answered perfectly. He measures the progress there on a per share basis rather than a gross basis, which I think is important. Randy Smallwood at Wheaton, he's grown that company since he was a project geologist, not even an employee. He's superb. The whole team I think, at Franco-Nevada, not just the CEO. There's a corporate culture of excellence at Franco-Nevada. If you, I'm not even going to say come down a notch, but if you come down a notch in market cap, the people who appear at my Boca conference in the living legends. So I'm thinking Robert Friedland as a founder and sometimes CEO, Bob Quartermain at Dakota Gold, Ross Beatty, founder and sometime CEO, Clive Johnson over at B2 Gold. There's a whole range of people that I think have been serially successful. I'm delighted, by the way, to hear Jay Martin suggest that when he came to me looking for career guidance 15 years ago. I said, find the 20 best people in the industry that you can and become indispensable to them. In Vancouver, Stephen Dean, I think, belongs on that list. Among the youngsters, I think Amir Adani has done a great job building a cult around himself, raising money, making intelligent acquisitions when the market was way, way out of favor. Yes, fairly high G&A, but you've gotten your money's worth out of his G&A. Looking in the exploration side, certainly you find folks like the Discovery Group, folks in the whole prospect generator camp. So Patty Nickel, as an example, at Origin, Dave Cole at EMX Royalty. The truth is that we're in very good position with regards to CEOs these days, particularly among the ranks of the smaller companies. It's the best crop of CEOs that I've seen in 50 years in the business.
Yeah, for sure. So two of my favorite, like coming down to, well, I wouldn't say, well, I guess I can express some favoritism, but
Sure you can.
cool. They cool, when I get to talk to them and engage with them and they come on the show and everything. But thinking about Craig Perry, also thinking about Alexandra, from Empress Royalty as well.
It's interesting that you pick those two, and that'll go to what makes a good CEO. Craig Perry's pretty easy because he's been serially successful. Even going back to when he was working for Owen Haggerty in Australia. Owen's somebody I've done business with for 40 years. So the fact that Owen liked Craig meant that I was predisposed to like him. But then he started making me money. And of course, Daryl, I liked him more. Alexandra, this is her first CEO role. But I've done business with, and particularly in competition with, her dad for 4 decades. And I thought, in the assumption that fruit doesn't fall far from the tree, she's pretty good. And the more time I spent with her, the more I liked her. I like her promotional style. I like her valuation style. She came up as a CPA. She's new in the game. She's been, the CEO of a standalone mining company for only 5 years. But she actually started in the mining finance business when she was 14 years of age, working for her dad. So despite the fact that she's fairly young, she's a veteran. And I like that. So I think you have good taste in emerging CEOs. Congratulations.
Yeah, thank you. So Michael Connor, him and I were the same age. And so just talking with him, I was thinking, like, you're the same age as me and you're managing this freaking this company, Vizsla Silver, that's over $1 billion market cap. Yeah, it was interesting just being able to see that come to the light. So yeah,
you spent too much time working for the government, Daryl. We should have gotten you and straightened you out sooner, but we didn't know you then.
Yeah, I know. I'm trying to make this money, Rick.
You have to be invested in copper. If you invest in the mining space, you need to be in silver, you need to be in gold, and you need to be in copper. Underinvestment that we've seen in the sector over the last 14 years of downturn means that there's only one way for copper to go over the next few years. BHP talk about copper demand rising by 7 to 9 million tonnes extra demand over the next 5 to 10 years. You can find more about Vizsla Copper at vizslacopper.com.
So just getting back to gold. So obviously the physical metal continues to run. Futures today are up over 3,800. I think it's 3,850 and some change, or maybe even higher than that. Fluctuates throughout the day. So obviously, I'm kind of wondering about the drivers for this continued move upward. Obviously, central banks buying, and I mean that's been something that has been talked about a lot at length. Um, and I've seen the chart recently where the reduction in U.S. Treasuries and now the reserves in gold has exceeded the U.S. Treasury holdings. And so, are we underestimating the force of this dynamic? I mean, do you see this trend reversing anytime soon, or do you think that central banks are going to continue buying at these levels?
I think central banks are absolutely going to continue buying at these levels for two reasons. One, the weaponization of the US dollar, the weaponization of the SWIFT banking system. Whether or not you agree with Russian foreign policy, the fact that the United States government stole $300 billion worth of Russian assets in the form of US Treasury securities did not endear the United States to other countries that think that they may run afoul of Congress or our president. The trend away from US dollar denominated instruments, in particular US Treasuries, and in favor of gold is a trend in motion. The BRICS have difficulty settling with each other in their own currencies because they don't want to own each other's currencies. But there's a mechanism in place now, in effect, BRICS money, where countries can settle very briefly in their own country and then convert that currency to gold, which means that gold is, at least in terms of trade between countries outside the US and Western Europe, again becoming money. And I think that's important. The second thing is that the US Treasury is arithmetically a bad deal. If you agree with me, where I suggest to you that the CPI is a lousy gauge of US inflation, where in fact the true gauge of US inflation is more like 7.5% or 8%, measuring the deterioration of the purchasing power of the US dollar. A US Treasury that's offering you 4.5 in a currency that's deteriorating at 8 is a lousy deal. It means you're losing 4.5% a year. And foreign governments aren't stupid. They've come to, recognize that to be true. The third thing that's happening, and this trend is only about 18 weeks old, is that you're beginning to see retail participation in the gold market, measured by funds flows into physical ETFs. It wasn't till about 4 months ago, despite the fact that we've been arguably in a gold bull market, really going all the way back to the year 2000, and a much more aggressive gold bull market in the last 2 years. It wasn't until between 15 and 18 weeks ago that we began to see a retail flow of funds into gold, measured by the physical ETFs. I think that's important for people to know. So if you ask, can this keep going? I would be a little stronger. I think it's probable that it will keep going. I think that, and I'm on record saying this, first of all, the most important determinant of the gold price is investors' favor or lack of favor in fiat currency denominated savings instruments, but particularly US dollar denominated savings instruments. And the arithmetic around that is not good. In the decade of the 1970s, the US dollar lost 75% of its purchasing power. I believe the next 10 years will be similar to that. If you believe that, it makes absolute sense that at least the nominal price of gold, the US dollar price of gold, will mirror the decline in purchasing power, which would suggest a threefold or fourfold increase in the gold price in the next 10 years. That's the good news for gold holders. That's the stuff that'll make all of your listeners with Jay Martin happy. The bad news is that even in a bull market as strong as the bull market that we enjoyed in the 1970s, where the gold price itself was up 30-fold, in the middle part of that decade, 1975, when the U.S. government fairly dramatically raised interest rates, the gold price fell by half. And the XAU fell, well, the predecessor to the XAU, fell by 75%. 65%, I'm sorry. The point of all this is that you can have a 10-year bull market where the price of an asset class increases threefold or fourfold and still conspire to lose money if you have one of these precipitous declines that shakes you out. So in real answer to the question, yes, you're on a train in motion, but it's not going to be a smooth ride because these rides never are.
Mm. Okay, got it. I do have a question just to follow up on that. So interest rates rose, gold price fell. How is that different from 2011 when we had the blow off top with gold and silver? I know we were quantitative easing, which we were printing more money, which ultimately devalues the dollar more. You would think that gold would continue to move up. What was happening there?
In the decade of the 70s, nominal interest rates increased threefold over the decade. So it's not correct to assume that gold can't rise in a rising interest rate environment. In 1975, when the U.S. government deliberately raised interest rates as opposed to following the market, savers and investors around the world got the sense that American society cared about the efficacy of the U.S. dollar. At the end of 1975, by the way, that interest rate rise didn't just crater the gold price; it cratered the Dow, cratered the housing market, it cratered the market for durable consumable goods like automobiles. Congress and the presidency lost their nerve, and they lowered the interest rate. When that happened, savers and investors around the world knew all bets were off. U.S. society didn't care about the efficacy of the U.S. dollar. The recent move that you've seen in the gold price, by recent, I mean the last 3.5 weeks, I think has everything to do with the fact that there is so much political support in the United States for lowering the interest rate, despite what the government tells us is a very rosy economy. Savers around the world are saying the U.S. society is not prepared to defend the purchasing power of the U.S. dollar, so let's buy gold. It's important to differentiate between a rising interest rate environment that's happening because investors are requiring more yield in the market relative to inflation, and a market where the government says, we hear you, we're going to increase deliberately the interest rate to maintain the purchasing power of the dollar. So it really depends on what the cause of the interest rate rise is and how it occurs.
Mm-hmm. Okay, got it. So when we think about so we have obviously the pressure to lower interest rates right now, and there doesn't seem like there's much effort to defend the dollar or whatnot. It seems like the dollar needs to go down. I mean, there's been a lot of pressure on emerging markets and many other places around the world with the stronger dollar makes it tougher on them, as well as interest rates here. I mean, obviously the cost of capital and such that was impacting many people. I mean, average people trying to buy a home, companies having to refinance at higher rates and such. And so are interest rates ever going to rise again? Are we like, is that done? Is that part is that part of our monetary policy done?
That's a huge question, Daryl. I don't think that there is a domestic political constituency for a stronger dollar. The president himself has said that he would like a lower dollar to encourage U.S. exports. And that's a real argument in favor of holding gold. You see, if we reduce our interest rates and lower the exchange rate in the U.S. dollar relative to Japan, and their exports falter, they'll have to do the same. One of the arguments that gold has in its favor is it's the only form of money that I know of. Perhaps crypto could join that, but I'm not sure. That doesn't have a domestic political constituency for devaluation. If the euro goes down, European exports are more competitive. If the pound goes down, British exports are more competitive. If the renminbi goes down, Chinese exports are more competitive, and so on and so forth. Gold is the only traditional expedient form of medium of exchange that doesn't have a political constituency for devaluation, which is interesting. The second point, I guess, no, let's leave it at that. With regards to the direction of interest rates, what you're starting to see in the U.S. is divergence in the market, which is to say the Fed is actively buying the near end of the curve and actively jawboning down interest rates. So the Fed is controlling the Fed funds rate and even the 2-year rate fairly effectively. Despite that, the long rate is going up, which means that the market is beginning to take control of the 15, the 20, and the 30-year. Remember that unless the Fed buys its own paper, the long market is a market. And recently, they've given some long auctions where not very many people showed up, which meant that the interest rate has had to rise, or the nominal pricing of the bond has declined. So it would appear to me that the political forces are still in control of the near end of the yield curve, which is to say 90-day to 2-year, maybe 2.5-year. But the long end of the market is becoming the province of the market. And it's almost certain from my viewpoint that absent a major recession, that the long end of the market continues to have to offer higher yield, which is to say the bond pricing in the long end of the market has to fall.
Mhm. Okay. So thinking about this, like the context of where we are today, I mean, for me, I've been, studying, these dynamics for the last 5 years. And, folks were concerned about national debt, deficits and spending and devaluation of the dollar for decades before I even got involved. Um, and I don't know if it's just me, but it seems just very like there's nothing's going to turn this around, obviously. And it seems like this is like the death of fiat currencies in how it plays throughout history. And not to say that to say like the dollar's going to go to zero tomorrow, but when you say that, you know, in the fiber of your being, the dollar's going to lose another 75, percent of its purchasing power, considering the fact that it's already lost 97% since its inception. I mean, that doesn't paint a good picture. And so it really makes the case for gold even stronger in this type of environment.
It's difficult for me, Daryl, to understand why somebody wouldn't own some gold. For myself, if a financial planner looked at my account, he'd say, Rick, you're out of your mind owning gold. As an example, I'm the largest shareholder of Sprott. If gold does well, Sprott's a brand name for gold. Sprott will do very well. But I own gold anyway because it helps me sleep nights and stay calm. I save in gold. I maintain liquidity in short-term US dollar denominated instruments. I look, and for that part of your audience who is Canadian, I apologize for this US-centric answer. But I know the numbers in the US. I can't tailor this to a Canadian audience. Our on-balance sheet liabilities at the federal level are $37 trillion. That doesn't include state and local. Our off-balance sheet liabilities, and you and I have talked about this before, Daryl. Our off-balance sheet liabilities, mostly entitlements, but also federal pensions and military pensions, is estimated by the Congressional Budget Office at $120 trillion. So the twin deficits, if you will, or the twin debts, pardon me, on and off balance sheet, are crowding on a net basis at least $150 trillion. Now, to put that in context, that debt is being serviced by a federal government whose gross revenues before expenditures like interest and military is $5 trillion. So you're servicing $150 trillion worth of debt with $5 trillion in gross, not net income. That's pretty ugly math. I believe that we have two choices. We can have an honest default where the government says to folks like me, yeah, I know you paid into Social Security for 60 years, which I have, but you're not going to get it because there's no money. Medicare, Medicaid, you say, too bad, so sad, no money, strong letter to follow. That's one thing you could do. You could be honest. You could say to holders of U.S. treasuries, foreign or domestic, yeah, I know we borrowed all the money. I know we own it. I know there's a piece of paper out there. We're nuclear armed. Come try to collect. Or, that's an honest default. Or, we could inflate away the net present value of the payment. Just like we did in the decade of the 1970s. In 1968, 1969, 1970, we were paying off the Vietnam War, which we lost. We were paying off the war in poverty, which we lost. And taxes couldn't go any higher because nominal tax rate was 70%. So what we did was we inflated away the value of the payments. We didn't index taxes to inflation. We didn't index our income. We just, in effect, de-indexed our debt. And it really worked pretty well. That in conjunction with an ugly recession and very high interest rates, we didn't reduce the size of government under Reagan, but we reduced the size and the growth of government under Reagan. And we allowed economic growth to make our debts, both on balance sheet and off balance sheet, financeable again. We took 10 years of pain to do that. And I think we face another 10 years of pain. We face, in a biblical sense, I guess, a reckoning. And we're going to get through it. We got through the decade of the 70s. But people who don't understand that math, people who don't understand trying to service $150 trillion worth of obligations on a $5 trillion federal budget, needs to understand that we either have an honest default or a dishonest default. It's interesting that, some of these progressive populist rabble-rousers, the AOCs of the world and the Bernie Sanders of the world say, no brainer. We'll just tax the billionaires. That's where the money's going to come from. These are folks who aren't good at math. According to the IRS, who ought to know, the aggregate net worth of America's billionaires is $6.7 trillion. And we owe $150 trillion, and our income is $5 trillion. If you stole all the billionaires' money, not increase their tax rate, but if you stole all their money, 100%, right? You would deal not with the debt, but just with the on and off balance sheet deficit for a year and a half. So when some of your listeners listen to this moron Bernie or Smiley, that's what I call AOC, and they say, well, we can solve this whole problem by looting the billionaires, make the rich pay their fair share. This is arithmetically incorrect. It doesn't work. The only thing that works is an honest or a dishonest default. Those are the only two things that happen. And people need to decide amongst themselves in terms of their investing, which is more likely. Given that it's a political process, I believe it'll be dishonest and that we'll have a dishonest default. We will we will inflate away the net present value of our obligations.
Yeah. Yeah. I was thinking about just what you just said there with the honest default and the dishonest default. And I'm actually reading the book End Times by Peter Turchin. And he talks about, real wages not moving up,
Yep.
since the 70s and just how many hours it takes of work it takes to put yourself through college versus the 70s versus now and such. And just thinking about that, imagine telling the folks that their real wages have not increased. Uh, Student debts at all-time highs, debts at highs, credit card debts, and just people are hurting because of um, the dollar's value that is lost over time. And then imagine telling them that and that you're not going to give them their Social Security. Like, I mean, I can only imagine just what kind of like revolution or revolt or whatnot could happen from that.
Well, mercifully for the country, I guess, if you did that, the folks who would revolt are old folks like me who couldn't do any damage. But there's a broader issue. Back in the days when you were a civil servant, I don't know if you're still doing that sort of thing, but back in the days when you were a civil servant, if you look in the period 1970 to today, your nominal wages probably would have been up 450% in a currency that deteriorated by 90%, which is to suggest that your real wages relative to the basket of goods and services that you were consuming was declining. There have been two ways to stay even in the last 50 years. Three ways, I guess. One would be to start a business where you had some pricing power. Deliver more utility in the business than you consumed as a consumer. The second would be to develop an uncontestable skill. Work in an industry where the utility that you were able to generate, often as a function of employing technology, increased. There have been some skill sets, coders, electrical engineers, things like that, speculators, if you were successful, where you're paid remarkably more, even in an inflation-adjusted sense, than you were in 1970. The third way was to become an investor who played the interest rate spread. Interest rates have been artificially low, and if you had access to credit and the intelligence to know how to use it, using borrowed capital to buy assets where the yield on the asset, like say a triplex, a fourplex, something like that, where the yield on the investment increased faster than the interest you paid. In other words, where your cost of capital stayed fixed and your return on capital employed increased. I was able, really beginning in 1982, because I had access to credit and I had a sense of how to use it, I was able to use the house's money. I was able for 30 years to be able to employ capital, not to consume, not to buy a Lamborghini or something like that, but rather to buy assets where replacing the asset was becoming increasingly expensive for new entrants because of inflation, and where my return on capital employed was increasing on an annual basis, but where my fixed costs, represented by debt service, were increasing more slowly, or better yet, staying fixed. People like me who had access to credit and the ability to use it were huge beneficiaries of the period 1982 to 2022. Huge beneficiaries. And the consequence of that was that our net worth increased much, much, much more rapidly than the deterioration of the purchasing power of the US dollar, or much more rapidly than the wages and hence net worth of most of the labor force.
Mm, okay. Okay. Yeah, that's helpful for me and also helpful for the audience because Daryl ain't trying to go out like that. So I want to touch on silver. I mean, obviously, folks look at silver in different ways. You got your stackers who stacking 100-ounce bars, kilos, and such. And then you got your folks that view it as a speculation. Some people view it as poor people's money. Um, Different ways to look at it. So silver is been catching a bid. And so just want to get your perspective there, especially for folks that are coming in and, they look at the gold chart and they see, oh, well, gold is up significantly, why not park some money in silver? So I want to get your perspective there.
Well, Darrell, we've talked about that a lot in past interviews, so I would urge people to review those interviews. But let's recap some of it. I believe that gold is a savings asset, an insurance asset, and silver is a speculative asset. The consequence of that is that I save in gold, but I speculate most in other materials, not silver. I do speculate in silver stocks, which I think represents silver on steroids. In my experience, precious metals bull markets are always led by gold. The first investor to the race is the fear buyer, and that's the gold buyer. Again, in my experience, when the precious metals narrative is established by momentum in the gold price by the fear buyer, the greed buyer steps in. When the generalist investor comes into the precious metals space for whatever reason, I'm not sure why it is, he or she goes to silver, likely because it has lower unit cost. And when that happens, leadership and momentum goes from gold to silver. That may be what we're in the middle of experiencing right now. Silver increasing in price faster than gold, although both of them are going up. The most volatile asset class in precious metals, in fact, in resources that I know of, with perhaps the exception of the junior uranium stocks, are the high-quality junior silver stocks. The leadership needs to be established firmly in the silver commodity quote. But when the junior silvers start to run, at least in the three bull markets that I've been alive, that's truly a sight to behold. I think it's because the combined market cap of the reasonable quality juniors is so low that when the generalist investor comes into the space, the money that comes down into that silo is so large that the market caps won't hold it. At least that's been my experience. And by the way, it's been a very joyous experience being long the junior silvers in those circumstances.
Yeah, yeah. What's your perspective on copper right now and how copper's doing? Obviously, it's gonna. I mean, we have a bigger, narrative of, industrial, mining and data centers and all of this demand for copper that's projected is there. What's your perspective on its performance so far?
The narrative's been in place for a long time, and there's two parts to the narrative. One is, as you suggest, increasing demand, not merely from data centers or electric vehicles, but also from our ability to lift up the poorest of the poor. There's 1 billion people on Earth that don't have any access to primary electricity. We're going to give it to them in the next 20 or 25 years, and that's going to take a bunch of copper. The other part of the traditional narrative, which is less well known but very true, is supply. We've underinvested in copper for 25 or 30 years, and the chickens are coming home to roost no matter what we do. We're going to have supply deficits 5 years out, irrespective of data centers. That's been true. But we've had, until the last 6 weeks, still relative weakness in the copper price, much like we've had relative weakness in the oil price, which tells me that the global economy is in worse shape than people suggest. You can have declining supplies if you have declining demand and you have flat to down prices. Just in the last 6 weeks, we've started to see a more renewed bid in copper because of unanticipated supply disruptions, capped off by last week's force majeure announcement from Freeport-McMoRan around Grasberg, which is by itself 3% of world copper supply. We have a circumstance now which is unheralded, where between 8 and 10% of the world's copper supply is affected by political difficulties, labor difficulties, or technical difficulties at the mine. And copper has really, truly gotten a bid. I don't think that this lasts. I think that Cobre Panama gets resolved. I think that Grasberg gets resolved. I think that Comoa gets resolved. I think that the strikes, the job actions in Peru get resolved. But I think 5 years out, there's zero difficulty in saying that structurally declining supply is a consequence of lack of new project and sustaining capital investment. Structural supply falls at the same time that demand from a whole bunch of places, data centers, but also emerging and frontier markets infrastructure increases. And I think that the copper price 5 years from now is materially higher than it is today. I can't speak to 5 months from now, however.
Yeah. Okay. And then in one of our previous episodes, you were diving into rare earths, and you were doing your due diligence there. I haven't talked to you about rare earths since that episode, but just want to see where you're at in your journey in understanding that dynamic, and are there opportunities there?
This is a hugely speculative sector, so investors need to tune out my answer because it doesn't matter to them. There's a lot of variability in rare earths, but as a speculator, I'm a real bull. Everybody points to the geopolitical tensions around rare earths, about the fact that mining them and processing them is really a Chinese endeavor, and that the Chinese are using them as an economic and political tool, and that there is increasing interest in non-Chinese Asia, which is to say Republic of China, Japan, and Korea, to get a non-Chinese source. The Americans would like to do the same thing. The Europeans would like to do the same thing. So there's a geopolitical scramble for access to rare earths. That's one part of the equation. But a more important part of the equation, really, truly more important, is the fact that the Chinese advantage in cost. And I should say, by the way, that we haven't looked for rare earths for 4 decades because the Chinese produce them so cheaply, there was no need to find them. What's happened in China is that China's cost advantage was a function partly of their willingness to endure ugly environmental costs around producing rare earths. And China is rich enough now that neither the Chinese citizenry nor the Chinese state is willing to endure the real cost of producing rare earths. And the consequence of that is that the cost of producing rare earths in China is rising fast enough that deposits outside of China are now and will be in the future increasingly competitive. Those two things, rising costs in China and geopolitical tensions, I think over the next 5 years means that those very few companies that control heavy rare earths deposits that are going to be cost competitive with China should do very, very well.
Mm-hmm. Okay. Yeah, that's thank you for sharing that. And then before we wrap up, I gotta get your perspective on Argentina. I was part of this investment class where we talked about opportunities in Argentina, and the stocks ran up significantly. There were some issues that came out, something with the elections, and then the stocks corrected significantly. And then now you have the U.S. government saying that they're willing to bail out Argentina or provide a loan or whatnot. And so I wanted to get your perspective there on those opportunities there.
You know, Daryl, it took real skill to wreck Argentina. At the end of World War II, the GDP of Argentina per capita was greater than the GDP per capita of Canada. It was the 5th richest country in the world. And the Perones, avowed socialists, and their successors wrecked that. I mean, it took real skill to wreck a country as great as Argentina, but they did it. The Argentine young people 2 years ago did something very, very, very different. They elected a guy, President Milei, who has turned around 75 years of socialism. He did something which is hurting him. Well, he did a couple things that hurt him politically. The first thing he did is he cut government almost by half. And federal workers didn't like that much, as you might expect. The other thing he did was that he ended exchange controls. So people whose money have been freed in Argentina for 75 years have been allowed to take some out. There's a lot of people who have 100% of their net worth in China and don't trust Milei's successor. So there's a tremendous outflow of capital in Argentina that's been trapped for 75 years. And this is a challenge for him. This is a real challenge. Trump has decided, for whatever reason, that he's going to make a swap line available to Milei. And we'll see if that works. Everything that Milei is doing is the right thing. Allowing citizens access to their own money is not a bad thing. So the fact that he ended exchange controls is good for Argentina in the long term, but it's very painful for Argentina right now. Those people are selling pesos and buying dollars. And that puts pressure on a whole bunch of stuff inside Argentina. If the Argentine people have the patience to continue with Milei's experience, and if Milei can sign fiscal stability agreements on large-scale projects to increase foreign investment in Argentina, I, for one, would love to increase my exposure in Argentina. If I had some sense that for the next 20 years, I could take my earnings out, which hasn't been the case hitherto. I think you'll see Argentina absolutely boom. I'm going to go down in 2026, and I may take some of my colleagues from the rural classroom to the extent that they want to go. I want to look again at the oil and gas opportunities in the Neuquén Basin. I want to take a look at some of the opportunities in San Juan and in Salta, in mining in the north. And I just want to get a better sense of Argentina as an investment destination.
Okay. Well, keep me in the loop on that, man.
Will do, sir.
So, Battle Bank, and you do gradings on your site, Real Investment Media. You got the Real Classroom. Share with the audience just some ways to connect.
Three things at least. The first is, yes, Real Investment Media. You like what I have to say about natural resources? Personalize it. Go to realinvestmentmedia.com, list your natural resource stocks, and I'll rank them 1 to 10. 1 being best, 10 being worst. The second is, if you're unhappy with your current bank, if as an example, you want to get paid interest on your deposits or bank in currencies outside the US dollar or borrow money against your gold and silver, go to Battle Bank. Battlebank.com, battling for better banking. The third thing, and your sponsor will love this, Daryl, I will, for the God knows how many successive years, be a keynote speaker at the Vancouver Resources Investment Conference in January, which is coming up much sooner than people think. So for those folks like yourself, Daryl, who live in the Pacific Northwest in particular, come to the VRIC. I'll see you there.
Yeah. Well, thank you for sharing that. Thank you for sharing all the value with the audience today. You all be sure to click the subscribe button. Love to have your support. Thank you for watching VRIC Media, and thank you, Rick.